Hi, I'm Steve Van Metre. Welcome to your weekly economic update where we take about 30 minutes every Friday to discuss what's going on in the market, take a deeper dive into the economic data, but which we just don't have time to do on our 15-minute updates on Monday and Wednesday. So let's start out with a kind of a recap of this week's written part, an update on the yield curve. And I don't want to labor too much over this, but it's very interesting that you have short-term rates and long-term rates are almost even right now. And the Fed doesn't think this is a big deal, but it's a huge deal because banks borrow from, say, the Fed at short-term rates, and they lend at long-term rates, and their profit is the spread. So when long-term rates are high, short-term rates are low, banks are very profitable. When they're tight, like they are now, banks shouldn't be that profitable. And when they invert, which they briefly did last week and they briefly uninverted, but when they're inverted, well, banks don't want to lend that much. Or things that they have been lending on, they're going to either tighten their lending standards up pretty high, or they're going to cut out of markets and focus on areas where they can make money. Now, a lot of investors will say, well, inverted yield curve is no big deal. It can take 6 to 12 plus 8 or 6 about 18 months before a recession. And that's true. In a normal market condition, that's true. And what triggers that? Well, you get the inverted yield curve. And then what happens is the Fed waits and hopes the market normalizes where long-term rates rise again. And then they're going to go back to raising short-term rates. But if long-term rates don't rise, or even if they just stay the same or fall, then the Fed is forced to lower the federal funds rate, and there's your recession trigger. The problem, unlike any time in the past, we're dealing with quantitative easing. I mean, there's hundreds of billions of dollars. The number is outrageous of negative yielding debt in the global economy now. Plus, the Fed has pumped up the balance sheet through quantitative easing 1, 2, and 3. Now they've retracted it a bit back to 2013 levels, but nevertheless, we've never seen this before. So it's possible that the yield curve inverting now, the signal may have been 12 months ago. So we may be already deep into that lag where all of a sudden the economy recesses. But right now, nobody seems to care. But it signals a lot of things are not right. And one of those things we'll look at in the charts is, well, volatility tends to spike really high. Now, today we have the non-farm payroll report that came out, showed, I want to say 179,000 jobs created. But here's what's weird about that. And I think that number's a little high. Maybe it'll get revised down. Maybe it won't. But here's the real story. The Bureau of Labor Statistics this year, so January, February, March, half the jobs created, totally made up. They're absolutely fictitious. They're self-employed jobs that the BLS has said, well, we're estimating that this many jobs are created. So half of the jobs aren't even real. Could you imagine if that hit the headline news? So today, there was, like I said, 179,000 jobs created. 51,000 of those came from the birth-death model. So really the number, is much lower, say around 120-some thousand jobs. And that's not that great. In fact, last month, the actual print was negative due to the number of jobs created or fictitious jobs created by the BLS. Yeah, but nobody remembers that. And so it kind of makes me wonder, why is the Fed pretty much capping the federal funds rate for a while? I mean, they could change their mind, but the last meeting they said, hey, our projection is this isn't going to change for the rest of the year. Why are they going to stop unwinding their balance sheet? Why did President Trump come out today and said that he wants the Fed not only to lower the federal funds rate by 0.5%, which Larry Kudlow has said, but he also wants the Fed to go back to quantitative easing 4. That troubles me. Why is President Trump trying to appoint people to the Federal Reserve Board who are dovish and will lower interest rates? Why are they all so worried about? Yeah, okay, 190-some thousand jobs, not bad. Sure, I'm sure they'd love to see 500,000 jobs created. Who wouldn't? Why are they worried? I don't know. Just something seems wrong. I mean, is the U.S.-China trade deal not going to be that great? It probably isn't, but there's been a lot of hype pumped into that. So it's interesting. What's going on? The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that everyone do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. I mean, you'd think people would want interest rates to get back to normal. I mean, there's a lot of retirees that would love if interest rates were 5 to 6% again. Putting them at 1 or going back to 2 at this point, that's where they want to go. They want the president wants the Fed to go back to 2. All that does is expand the wealth gap. It doesn't help millions of Americans. Believe it or not, higher interest rates are actually better. I mean, they really are. So I don't know what they're up to. But anyways, let's go on to the charts. I start out with the money supply. So I think I mentioned on Wednesday there some of the danger signals here. So the year-over-year growth rate, the annualized growth rate is down to 4.04. We know that's going to continue to slide. How do we know? Well, the 6-month rate of change is at 1.9. So you can double that. That's at 3.8% per year. So that means that the year-over-year rate should continue to fall because the 6-month rate of change is leading it. The second thing we know is the 6-month rate of change is going to continue falling because the 3-month growth rate is at 0.5%. So multiply that by 4, and it's telling us the money supply is growing at 2% a year right now, and the rest, and the 6 and the 12-month data just haven't caught up. And that is critical because how can you have stock prices and economic growth when the money supply on a 3-month basis is growing at 1/3 of its long-term average? 1/3. It doesn't make any sense. Something in the economy has to give. Something has to break. Part of this, what we're seeing is we saw oil prices come down. It was trying to create some relief. And what happened? People thought oil was too cheap and they've driven it back up. Stock prices came down to create some relief. People thought, oh, they're too cheap, drive them back up. So interest rates are falling and traders are trying to push them up because they think inflation's coming. They think this U.S.-China trade deal is going to be really inflationary. It's not. It's going to be actually just the opposite. I'm probably going to write about that for next week. But the money supply is telling us it's not growing fast enough at all. In fact, if that 3-month rate of change goes negative, just keep in mind, it has never happened since 2009. And before that, it doesn't happen very often. But what it's telling us is the money supply is not growing fast enough. The economy is not growing as well as everyone is claiming it is, because if it was growing and there was lots of borrowing going on and lots of expansion, not only would the money supply be somewhere, say, growth rate would be up here, that would do it. Plus interest rates would also be much higher. The Federal Reserve balance sheet decreased $20 billion for the week. We kind of knew that was happening. We've been tracking that. That would be for last week, since they're always a week behind. Again, still no Fed bailout. We're down to 2013 levels on the Fed's balance sheet. The number of companies in the S&P 500 that are entering a blackout, we are right here at 45% as of Friday. By next Friday, which will be the 12th, that will be, so we'll be right around, say, 75% of the companies in blackout by the end of next week. Plus, next week we have some big Treasury auctions coming, so that's going to pull liquidity at a time when liquidity is getting tight to begin with. And one of the challenges coming up with earnings season for the first quarter is earnings per share are showing way up here based on the stock market being, say, over 2,800, now a little bit higher than that. And the actual earnings per share are down here with the S&P 500 being closer to 2,200. And this relationship can actually persist when the Fed is easing. But when the Fed is tightening and there's not a lot of money sloshing around, it can go the other direction really, really fast. And so the market, in terms of stock prices, is way ahead of itself. And this is the latest earnings growth projections from FactSet. You can see on an annualized basis. So from last year, the S&P 500 expected to have a minus 3.9% earnings growth. And yet, where are stock prices? Well, they are, from a year ago, higher. That doesn't make any sense. Doesn't make any sense at all, because earnings growth is negative over last year. So either this is wrong and the stock price is right, or stock prices are wrong and they need to come way down. And so you can look at utilities, healthcare, real estate, industrials, communication services, financials, consumer staples, consumer discretionary, information technology, materials, and energy are all going to show negative year-over-year growth rate on earnings, or not negative, but all lower or negative depending on the sector. But look at energy. There's a reason I've been saying there's something coming, an opportunity in the energy sector, because the market's not pricing this in. The executives, the big players they know the real numbers, and they are selling their stock. That's what the data is showing, and the public's buying it because they think inflation's coming. They're wrong. So we'll see as the energy companies get to their blackout and then start posting their earnings. Opportunity is going to knock there at some point. Let's continue on. This is a follow-up kind of on the yield curve. So here we see the 10-year, 2-year Treasury yield curve advanced by 36 months and reverse. So that's in dark blue. So it's upside down. And this is VIX, or volatility index, with the 3-month average adjusted for log scale. And what it's saying, you can see as the yield curve normally goes down, volatility rises. So they've inverted it so you can see the relationship. And what that tells us is volatility should be rising. It should be rising quite a bit. We're talking 2008 style volatility, 2000 style volatility, and that should bring stock prices way, way back down to reality. So right now when people are looking at the market and they're talking bullish, you have some of the worst global economic data since the last recession, and you have high stock prices, decelerating money supply that's on the edge of going negative. You have the BLS making up jobs like crazy. And it doesn't, you have a president who wants to go back to quantitative easing 4. What do they see that we don't know about? There's something, because as of right now, President Trump should be thrilled. He should be saying, "Hey, raise rates. Let's help savers. Let's do this. Let's get rates up so we can bring them back down." But he wants to lower rates and print money. And I'm going to tell you, wanting a weaker dollar, I know why he wants a weaker dollar, because he thinks he can export his way out of our problems. We're a reserve currency. You get a weaker dollar, you get inflation. You get inflation, you get the Fed tightening into a recession. That could happen in a big way. Let's go see what the big banks are up to. And this is pretty interesting. They bought, this is the H.2. I've already zoomed it in on the Federal Reserve website. So you can see Treasury and agency securities, they are up by $16 billion for ending last week. Mortgage-backed securities up $9 billion. So that's $25 billion there total now. And then adding non-mortgage-backed bonds, that was up $7 billion. So you're talking $32 billion. The banks are buying in bonds, not stocks. They're not selling bonds to originate loans. They're buying bonds. It kind of tells you that the stock market's going the wrong direction, because the banks are seeing something that the stock prices are not reflecting. And when all else fails, the banks are right. All right, so let's head over and roam through some charts and see what we see there. And then we'll flip back over and look at one last thing. So you have to argue this is a pretty bullish perspective. Makes you think the S&P 500 is going to head to retest its all-time highs. Very well could happen. But with the largest buyer of stocks, which are corporates, going into a 75% blackout next week, it seems hard to believe that could happen. Now, from a volume perspective, you can see trading volume is falling down. That makes sense because corporates are getting blacked out. They've been buying stock. It also tells you as prices rise and you get up here, volume starts to fall, as not only is there's less money to buy stocks, but the amount of money people have doesn't buy as much stock. So let's say I had, $20 million I'm investing for people, and I want to buy S&P 500. Well, I can't buy as many shares right now as I could, say 10 years ago when they were really cheap. So that is an issue. So the higher the stock prices go, the less shares people can buy. And that's part of the reason why the decelerating money supply matters. If the money supply is only growing at, say, 2%, when its historical average is, say, 6.5%, well, that doesn't lead to rising stock prices because there's less money that can be used to buy stocks. Well, if there's less money, that's less shares. Less shares mean there's less demand. Less demand means lower stock prices. You see, it all kind of makes sense when you bring it back to the money supply. Let's take a look at the bond market. So here we'll take a look at 10-year Treasury yield. They gapped up today and immediately found sellers. We see this red candlestick. And as I kind of mentioned, I don't know when, but we got to zoom out, is what was happening here. It could have been Wednesday, maybe Monday, not 100% sure. Don't remember. Anyways, what you see is it bounced up to this level here where there's prior areas of what are called resistance. So it's not a strong zone of resistance. That's much stronger up here, say at 2.62. It's not looking like it's going to get there. So it hit this little intermediary resistance zone, hit a negative there, means the next destination for yield should be a retest of the March lows with a shot at finding support at 2.32425, right? Right in there where the solid purple line is. That's where yields should go. A breakdown of there would send them quickly down to, say, roughly 2.2, where they might bounce up or go all the way back down to their pre-election low somewhere there. But there's a lot of air in between here. There's a couple weak areas of support, but they're not super strong. But what we see from a price, or I think it's not really a price action, from a chart action, is this is bearish setup for yields. And let's also compare this to the S&P 500. And there it is. So you can see the S&P 500 and 10-year Treasury yields track pretty well. And based on this, the S&P 500 should be around 2,500. Now, to show you this relationship is very long-term, we're going to zoom out to the weekly chart. And you can see that they kind of track each other. And as I move this to the left, you can see how they kind of start to line up. And you say, well, it's a little off there. It is. But we can zoom. Let's go to the 20-year chart. I did this earlier. It's like all things. When I test stuff before, it works great. But when I do it live, sometimes it doesn't always work. So let's see. Here we go. See how it starts to line up real pretty? And then as we scroll across, you can see the tops and the bottoms start to line up. And it's not until roughly right around, say, 2010-ish, these split apart. Now, if we use the weekly charts as an example, it tells us the S&P 500 shouldn't be much, much lower, say around 1,500. We'll not make that call just yet, but it gives you an idea that the relationship between stock and bonds is way, way off right now. So one of the questions that comes up is, who's right and why? It's a bond market. There are far more bonds traded, and there's far more bonds and money in bonds than there are stocks. So the bond market's always usually right, almost always. In this case, because of all the short sellers, it's telling us something very clearly. The global economic growth is not that strong, and the stock market is mispricing all of this and will eventually have its moment where it adjusts. It's either that or yields have to go up. There's no signs of, money printing inflation. I mean, there's inflation, but price inflation is going away. Let's look at 30-year yields here. This is very interesting from a chart perspective. Oh, good. We're on the 2-year chart. Came down here, found, into this area of support where it gets jumbled, and it could be a zone here. We could have drawn a line. But anyways, came in here, bounced off this, and what did it do? It tagged its resistance line up here when we see there's lots of resistance right in here. I mean, there could be we could in fact just do this and say there's a zone right in here, and it got into that zone, bounced, and now that means it's likely to come back, revisit support here, but the major support remains right around 2.75%. That should be the next direction for yields. It should bring stock prices down with it. There's no question about that at all. So let's take a look at oil and gas producers. This is kind of surprised. So yesterday, it kind of bounced over its 100-day moving average, and then today on pretty decent volume, people got really bullish about the oil and gas sector based on the payroll report, and there's really no correlation there that I've found. But here again, let's overlay the S&P 500. There you go. And you can see there is a long standing relationship with these two as well. And based on this says the S&P 500 should be, say, around 2,500, should be much lower than it is now. And the question is, who's right? Oil and gas producers, who are major employers in the economy and provide a lot of money in the economy, or the broad stock market. I'll let you decide, but it's most likely that when you have two signals, the bond market and the oil and gas market telling you the stock prices are wrong, there's a good chance that stock prices are wrong. Now, can this get up here and bounce off resistance? Possibly. You can kind of see right in here, and it's kind of broken over. It's now high since the first part of the year. So we see it kind of peaked here, and it just touches nose over it. So the oil and gas market is pretty much saying, we also don't believe in these oil builds from the EIA last week. They don't believe it. That's odd. So will next week's build matter? We'll see. I mean, something's going to change. Investors are clearly on the wrong side of this. Let's take a look at gold futures, sitting right under resistance here at 1,300. Can't break through. It gives repeat story, can't break through. Again, tells us at some point gold heads lower to retest support at either around 1240, 1250, or somewhere around 1,200. We'll see where it goes. When we overlay volatility, let's put the volatility ETF, and it tells us that gold is most likely coming down to, say, somewhere around 1,200. It does track volatility, and you can see the volatility spiked up here, gold spiked, and there is roughly a 2-month lag. So maybe gold is sitting right up here. Well, there you go. So it came down. Gold came down, bounced up, came down, a small bounce. There you go, 1,200. Could be a good buying opportunity. I think it actually is. Let's take a look at the mining stocks. They got a little excited today. Again, bounced over there, back over their 50, or stayed over their 50-day moving average. Again, that ought to send these back down to the $19 range. That would be a nice area of support, nice place to buy. Would confirm what we know is going on. Taking a look at emerging markets, this did not come down and tag any form of major support. This ought to head lower again. The global growth story is not there. I don't know what investors are up to, but they are pretty excited about it. Taking a look at the 7 to 10 year Treasury Bond ETF, it came up through this little resistance zone, got rejected, came back, found support. Now look at the support zone is going back over the last, say, 2 years, and you can see it's a nice little area of support. Found a little bit of buying here. From a volume standpoint, you see sellers down, and then sellers are running low on volume, so that tells us that the cards are going to flip to the buyer's hand. And from a longer term perspective, we should expect to see this in the 108 to 109 zone, and a breakout there has got every chance at running back to its all-time highs. The long bond, TLT, it came down to a very soft area of support right in here. You seem to find some buyers as well, and that's setting up a stage to run up to the 128, 129 level in there as well. Again, a nice bullish setup. I don't like to always look at individual stocks, but Tesla's pretty interesting. A lot of people are interested in what's going on with this company, but from a charting standpoint, it's pretty interesting. Prices came down and are running into this resistance zone here. If they don't hold resistance at 275, they're going to come down and retest support at 250. And people that are following this a lot closer say that Elon Musk gets a margin call on all of his shares that he borrowed money to buy around 220. So if it breaks below the, say, 250 level, 240 to 250, we'll just say this gap right in here, these two purple lines, that tells us their stock's heading down to 180, and you might get a CEO selling, which is pretty interesting stuff. CEOs have driven their stock prices to the ground before, so this wouldn't be a surprise if that happened. Now, before we look at the ag chart, let's take a look at the weather pattern. I'm mostly interested in rain. Now, this updated today. So earlier when I looked at it, it showed that rain was hitting this week in the growing region here, and then was moving east. And we know that there's baseball sized hail coming to the south part of the United States because they're getting a bomb cyclone, just like the Northeast got. And so more rain in this growing region is bad for farmers who are already flooded, and they need the ground not only to dry out, but they've got to clean it off to get their seeds in the ground prior to whatever the cutoff date over the next month or two, because you cannot ensure your planted crop is not in the ground. And you can see that rainstorm is moving right there over the next 2 weeks into the southern United States, followed by another rainstorm coming across. Again, NOAA has predicted there's going to be more storms. And if we take a look at the sunspots, well, there's none, and there's been none. So that's that's the main reason we have this inclement weather, unusual weather. And looking at the latest sunspot chart, if it'll pull up, maybe not. All right, well, maybe it was working earlier. There it goes. You can see this is updated as of March 4th. The number of sunspots is roughly 0. That matches when we were knee-deep in a recession in 2008 and 9. And as I've said, this is going to be a bad time for a recession, because this is when productivity is at its lowest. Humans are more productive when it's warm, not when it's cold. And when you get very few or no sunspots, the weather goes wonky. All right, now let's go back to the chart of ag commodities. We'll get rid of that. There we go. And so today, let's go back to yesterday. So a big price move, not a lot of volume, short sellers getting squeezed out here. Not a surprise. We see some selling coming in overnight. Why is that? Because it got up into this light area of resistance back in December and here in February. And so you get some sellers here, and it came down to support, which would be this patch of buying and this patch of buying, and it held, and boom, there you go. Their other news in this sector is there is swine flu going all over Asia right now, and they're going to have to kill a bunch of pigs, so it's driving pork prices up. And of course, once the USDA gets out and checks all the flooded stored grain, we're going to see grain prices go higher too. So where does this go? Next, we should see a move probably up to the 1771 level up here, and then a move up into the $19 range, potentially break out from there. This is the big sleeper sector in the economy. So, all right, I mean, in terms of, just upside potential based on the historic 11-year cycles and the weather conditions already, you have worse flooding in history in many states as it is. So a lot of upside for ag commodities, especially if any part of the trade deal has China buying stuff. Now, I've heard it is, and there's rumors that it could take them 6 years to ramp up, but anything that pulls whatever's left of farmers' inventory, plus knowing that many of them are not even going to be able to plant this year, so we're going to be drawing down on our stored grains, just going to drive prices higher and higher. So with that, we'll be back Monday night for our 15-minute live. Appreciate you taking your time to watch. So I'm Steve Van Metre. If you have any questions, give me a call. Send me an email. Here for you. Bye now.